Hi, this is Victor Cuevas. I'm going to go over a case study involving a young couple with some things they brought to me and kind of wanting my advice on maybe which direction to take. So I'm going to start by writing down some of the parameters we have to work with in this particular case, and then we can go from there. So we have a couple that's 27 years old, both of them. All right, and of course they have a young child, and we're looking at, let's see here, their situations. The mother has recently left employment, and she's sitting on approximately $13,000 in a pension. We have about $6,000 in credit card debt. Okay. We have, I think, if I remember right, $10,000 in auto debt. Okay. So those are just quickly where they're at. Actually, not in a bad situation. What would be typical family needs for a couple in their 20s with a young child and looking forward to a great future? So let's name them real quick. We have, well, obviously, we need a rainy day fund. That's important because what happens with a lot of families is things come up, car breaks down, something happens with the house, an emergency arises, and next thing you know, they're into the credit cards and into the debt because there is no savings or very little savings. So we definitely want to be able to build up that savings account. Retirement. Well, the earlier you start on retirement, obviously, the better it is. Someone can start young in their 20s, saving a couple of $100 a month, and by the time they're in their 60s, they'll have way more than someone that starts in their 50s putting $1,000 a month. So it's crazy how the numbers work, but the sooner, the better. So, retirement. Well, most families think about college funding. Many families out there that went to college, they have student loan debt. They understand, the hardship that can create in someone's life, so why not, if possible, be able to create a situation where their children can go to college and not incur massive debt. So college funding is important. Of course, there's life insurance. Every family needs that. About 60% of families in the United States have life insurance. The rest, I don't know what they're doing. And so that's important. And then when you look at those 60% of families with life insurance, most of them are underinsured, or they're not in the right kind of life insurance to begin with. So life insurance is very, very important, especially in young families, or families that have any kind of debt, or families with a stay-at-home parent. This is important. What happens is what happens if the primary breadwinner dies unexpectedly, prematurely? Well, family needs income, and that's where life insurance comes in. So you gotta have life insurance. And then another thing that a lot of people don't mention is opportunity. Well, Victor, what do you mean by opportunity? Wouldn't it be nice if a family in their 20s, by the time they're in their mid-30s or so, or 40s at the latest, because of proper planning or because they were aggressive savers, were sitting in a situation where now if great opportunities come along, business opportunities, real estate opportunities, and things like that, they have money to invest. Money that they could, invest safely without affecting the rest of the budget. And those opportunities can lead to substantial wealth in many cases. So opportunity, people, if you can stay out of debt and get a great savings plan going, wow, wouldn't it be great to be able to take advantage of opportunities that come your way. So let's go over there. We have a family that's 27 years old. They have $13,000 in a pension plan, $6,000 in credit card debt, $10,000 in an auto loan. In typical things that young families might want to think about, or anybody really, it's rainy day fund. You should leave it. Be nice to have at least 3 months. 6 months is great. And if you had a year's worth of savings set up, you'd be like royal, like that. Retirement, very important that you start as young as possible, saving as much as you can for retirement. College funding is very important, especially at a young age while your children are still young. Life insurance, got to have that. Come on, got to have that. And then being able to capture any opportunities that might come your way in the future. So this family is concerned, their main question is, what do we do, Victor, with the $13,000? Now, they told me that if they left it in there in that retirement account, it would grow for another 5 years. Now, if it's in a pension plan, it's going to grow very conservatively. And after that, it doesn't grow anymore. More likely, they'll be able to access an income stream later on in the 60s, but it's not going to be very much. Or another option is just move that money straight out of there into an IRA and put it in the market. Not my choice. It's pension money. It's retirement money. I don't like the stock market. I've been a financial advisor and licensed with mutual funds for several years, some 20 years, and I got out of all of that because in the 21st century, the stock market just isn't working for the average family. So money that you want to be secure forever, that money you can retire with, is better in some safe money vehicles that will make good returns, but you never can lose it. It just grows and grows and grows. So we could put it in something like that, or if they want to put it in mutual funds, they can. But that's an option. Just put it all on there and just let it grow for the future. But they did express concern of this debt and asked me, well, why, would it be prudent to take the money out, there's going to be a 10% penalty, and use it to pay off this debt? Okay? And then have some left over that they can then invest, in a retirement account. Well, that's a consideration. And it's one of those considerations, if you're going to take retirement money, cash it out and use it to pay debt, you want to be disciplined enough not to go back into debt, to control the debt, to stay out of debt, to be able to save money and not get back into the debt. So, you may have an occasional car payment, things like this, but credit card debt is really what's killing families today. So, that's certainly an option, and it's not a bad option, especially at 27 years of age. Will the $13,000 be worth a ton in retirement? If they contribute to it, it could be a pretty decent bucket of money for them in the future. So those are the questions. Do we pay off debt? Do we just leave it where it is? Do we move it into an IRA with mutual funds? Those kinds of things. Well, I'm a little different than most guys because I look at alternative ways of doing things. But what you'll see with your typical mutual fund guy out there, especially if you go to some of these insurance agencies that they get a license and they want to give financial advice, they will more than likely say, let's go ahead and move that over into an IRA. I've got some great mutual funds to put it in and let it go. It's easy, no problem, no thinking, and you just let it go up and down in the stock market or whatever. I've got a different alternative. And I'm going to explain that alternative so that all of you listening to this can make up your mind using your common sense whether this is a pretty good alternative or not. Now, what I'm going to tell you about is something that these so-called gurus like the Dave Ramseys of the world and the Clark Howards of the world in Atlanta will say it's the dumbest thing you can do. But many wealthy people and the banks think completely different. So who should you listen to? Well, I just want you to use your common sense. Now, I'm going to show you something that's going to take care of this debt. All right? I'm going to show you something that creates a rainy day fund. I'm going to show you something that contributes to retirement. Beautifully contributes to retirement. I'm going to show you something that takes care of college funding. I will show you something that takes care of life insurance. And I will show you something that takes care of opportunity. Everything here is taken care of, including this debt, with one financial instrument. You're probably saying, hey, come on, that's ridiculous. How can one financial instrument take care of all this? It's not new. It's only been around for a few hundred years, but very few people, well, I say very few, relatively speaking, in the financial services world, financial advisors out there and agents of all kinds really know very little about this. They know the name of what I'm going to tell you about, but they don't really know how it works. And because of that, they just, not a good alternative. They're wrong. It's a great alternative. Banks own billions and billions of dollars of what I'm going to show you. They are the biggest purchasers of this financial instrument. Why? Banks aren't stupid. They put their money where it's safe, and where they make money, it's an asset to banks, and they wouldn't be without it. And a lot of very famous people in the past have used this to fund companies like Walt Disney, Pampered Chef, JCPenney, McDonald's. All those companies were in part funded by what I'm going to show you right now. So here we go. What is it, Victor? I'm dying to know. What are you talking about? It is called cash value whole life insurance. Oh, no, not cash value whole life insurance. It's cash value whole life insurance with a mutual company that has a paid up additions rider to it. Specifically designed to create cash value, to act as a bank, to act as a rainy day fund, and to act as a retirement fund, all in one. And tax-free. Doesn't get any better than that. So if you go to your State Farm guy and you want to get some insurance, he's going to want to put you in whole life because it's expensive and it makes a better commission for him. So all the money goes into the death benefit. So you have this death benefit and you have hardly any cash accumulation for years. But if you come to someone like me who designs it for a specific purpose, not just life insurance, to design it to create cash, to create a rainy day fund, to create college funding, to create retirement, well, we need that thing to produce cash value, strong cash value. So when you design it the right way, it absolutely becomes a great savings vehicle, better than anything else out there you can save your money in. All right? So, mutual companies are companies that are owned by the policyholders. They're not public companies, so that you don't have a bunch of shareholders taking a bunch of profits before it goes out to everybody else. You are the policy owner. You get the profits. That's why these things pay great interest and dividends. Okay, so that's where you want to be with a mutual company. Also, we design it so that little money goes, as little money as possible goes into the death benefit, which is the most expensive part of it, and the rest goes in what we call paid up additions. When the money goes in there, it buys a certain amount of life insurance that's paid up. If it's paid up, there's no cost. So now that money sits there and just throws out cash like an ATM and no cost coming out of it. So that's why these things can generate great cash. And what happens is in the first year you have it, you've got a lot of cash value that you can have access to. Not like these other policies that may take years before they generate any substantial cash value. When you look 5, 10, 15, 20 years down the road, the cash value can get substantial in these things. And then when you get to ready to retire one day, it's going to pay out a tax-free income for the rest of your life. Tax-free. So that's in a nutshell what I'm talking about. How would it work in this particular case? It works like a charm. We've got this $13,000 and we've got this. Why don't we go ahead and cash it out and take the 10% hit? Okay? So we're going to lose what? $1,300 out of this. So we have a little less than $12,000. All right? So let's just put 11,000 here, 11,500. Well, I'm losing it here. Hold on, I'll get right back. Come right back. I suppose there's 11,500. There's more than that, but okay. That goes into the policy. And because of the way we designed it, most of that money is going to be available day one. Okay? And then you decide what you want to contribute to it every month. Now, remember, we need a rainy day fund. And if you're putting money aside in a savings account someplace, it's good to have, some money in the bank. But the bulk of your savings should be going right here. It becomes your rainy day fund. Well, when $11,500 goes in there, and most of it is available day one, and by the end of the year, very close to that amount is going to be available, you have a rainy day fund instantly that if you needed to, you can tap into. So it's already taking care of the rainy day fund part of it. See, we want to preserve this money. Remember? Wouldn't it be nice to preserve this money and have it grow for the rest of your life instead of just, it's gone on debt and you never get it back? I mean, it'd be nice to pay down its debt, but it'd be nice to keep that money at the same time, right? All right, here we go. So now, we've got cash in there, and we're paying on these credit cards probably 15%. All right? Well, now that we have cash in here, now this provides a death benefit. We have to design it around a life insurance policy. I don't know what the death benefit is going to be. Once I figure out the numbers, it pops out, this is what the death benefit is. That's great. Well, a death benefit takes care of life insurance to a certain extent. And if it's not enough, we can augment it with a term policy. It's real cheap. But it's going to take care of the life insurance aspect. And this will throw off a pretty good death benefit. But it's not what we're worried about. But it just happens to take care of this thing. So let's go ahead and mark this off. Yeah, takes care of life insurance, right? So now, what about this debt? I'll tell you what. This family's already paying on that credit card debt, right? To the tune of 10 to 15%, maybe even more. Why don't we take a loan against the cash value in this life insurance policy for $6,000, stroke out a check, done. Credit card debt wiped out. As far as the credit card companies are concerned, you paid it off. The credit bureaus, hey, you did great. You paid off $6,000. Bam! Credit score goes up. Right? Now you're paying the $6,000 back to the insurance company. Now they didn't pull your money out. They just keep your money as collateral and loan you $6,000 at 5%. Payment goes down. Now what I like to do is go ahead and pay this back at 7 or 8 or 9%, right? The excess money just goes into paid up additions, grows your retirement money even more, grows your rainy day fund even more. But if you want to keep it at 5%, just keep it at 5% and just pay it back there to the insurance company. If you need to miss a payment, you miss a payment. No one's going to come knocking on your door and say, hey, you're 30 days late, mess up your credit. It's paid off. take care of this debt, credit card debt, pay it off, you're paying it back. Now, here's the thing. While you're paying this debt back to the insurance company, your entire cash value is staying there, cranking out interest, 4 to 6%. Like clockwork. Just paying it out. Okay? So what have we done? When you get finished paying the $6,000 off, you'll have even more cash value in here than you started for, because it's just been building up. So what happens is, and within about a couple of years, you'll be back up to this original $13,000. I mean, it won't take long. So what have you done? You preserved the $13,000. You didn't lose it. And this policy was worth a ton of money when they're in the 60s and want to retire. So we preserved the pension. We paid off this credit card debt. We've got life insurance and we got a rainy day fund. With me so far? This is a beautiful thing. Retirement, they're putting $100, $200, $300 a month on this thing. It's building the rainy day fund at the same time. It continues every year. The death benefit continues to go up. And they're building up their retirement, which is going to be tax-free one day. So now, you wanted to turn this into a retirement plan. That's what it was. Now you got a retirement fund right here. Read this so far? Now, they borrowed to pay their credit cards off, right? Do you think they could, when they finish borrowing from this thing here, their auto debt is going to be lower? Hey, borrow from it and pay off the car. Well, the car might be paid off, but if it's not, pay off the rest of the balance on the credit card. Pay it back to the credit. Guess what happens in 20 years, in 18 years when the kid gets ready to go to college? How much money do you think is going to be here? $100,000? $150,000 in cash value? Very, very likely. I'll have to run an illustration. Do you think there's enough money to take care of college for the children? No, we don't need to take the cash out. You could. Just borrow against it and pay to college. When your son retires but gets out of school, have your son or your daughter pay off the debt. You know? Meanwhile, when this thing's up to 20, 30, 40,000 bucks, there's pretty much you can finance anything in the world you want. What I would recommend is go to the car, go to a car dealership, get your car, pay it for 6 months, pay a note for 6 months to keep your credit going, or 3 months or 6 months, and then take a loan, pay it off. Pay the insurance company back. Continue to grow that cash value. Go on a nice vacation. We want to take our kids to Disneyland. Well, it's going to be the vacation of all vacations. We're going to have 5,000 bucks. Fine. Borrow out of there. Pay it back. Put it on your credit cards. Get the points. Pay off the credit cards at the end of the month with money from the from loan from here. Keep going. 5%. Cheaper than the credit cards. And if you pay 7 or 8% back, you just keep boosting that money even more so. Puts it on steroids when you put a little extra in there. As the couple starts earning more and more money, they put more and more money into this thing. Who knows how much money that'll be in there. So, college, pay for it. Opportunity. Let's suppose they hit 40-something and there's $200,000 of cash value. You can pick up a house, an old junker house for $80,000, fix it up for $30,000, and sell it for $150,000. Where are they going to get the money? Borrow from the life insurance policy. Some other investment comes along that's safe, that's conservative, that has a good return. They got the money. Let's see here. Opportunity. Took care of the auto debts in the future. All of these things are taken care of buy one policy. When you took this money, you cash it out, you put it into a life insurance policy, properly structured to create lots of cash by someone who knows what they're doing, right? Or someone like me, that's going to accomplish all of this. And they will get into their 60s debt-free with a nice, healthy, tax-free retirement to add to anything else they have saved up from 401ks or whatever, or other pensions during their lifetime. That $11,500 will turn into a gold mine. They'll preserve their pension, get out of debt, stay out of debt. Understand me, stay out of debt. Lots of people, some people get out of debt, they don't stay out of debt. Preserve this, pay off debt, stay out of debt, have a rainy day fund. How would you like to have $50 or $60 or $100,000 rainy day fund? Man, it'll get there. Take care of retirement. Have a retirement bucket here to add to everything else. College funding is taken care of. Life insurance for sure is taken. By the time they hit 40 years old, this thing might be $1 million. Man, life insurance goes up every year. They get into the 60s. Who knows how much life insurance is going to be in there. And opportunity, when it comes along, they have a bucket of money to borrow from. That's it, folks. Now, I just want you to use your common sense. If you use your common sense, this makes all the sense in the world. And what do we call this? Call this, well, the founder calls it infinite banking. Popular name for it is bank on yourself. Bank on yourself. That's it. Short and sweet. That's just the concept. You think about it, you look at it, and how it can apply to your situation. You may not have $13,000. You may say, I can put away $500 a month. I can put $300 a month. Or I got $2,000 over here, and I can add to it. Well, you start where you want to start. But for this couple here, this is a slam dunk. Slam dunk, as far as I'm concerned. Now, I can help them with traditional ways, but this is far better than any other solution. So that's it. Again, this is Victor Cuevas. I hope this has been helpful. And, hey, any questions, concerns, whatever, I'll be happy to talk to you. Take care. God bless.